Quick question. Ever wondered how many startups you would need to invest in to guarantee a return? Well, a little while ago, I came across this blog by Kevin Dick from Rightside Capital that discussed just that. Supposedly, 15 investments give you a 90% chance of getting at least your money back. 200 investments give you an 80% chance at tripling your money. Is that true? Well, in today's video, I chat to David Lambert, who is also from Rightside Capital, who employ a strategy with this exact theory in mind. Right now, they're one of the most active investment firms globally with a portfolio of over 2,000 businesses. Listen in as I learn more about what it takes to become a successful investor and David's own journey to become one. Happy to start, David?
Yeah, fire away.
Awesome. All right, so David, would love to give you a chance to introduce yourself before we jump into things as well. Can you tell me a little bit about what your journey has been like so far and what you do at Rightside Capital?
Yeah, so I'm one of the founders and managing directors of Rightside Capital. We call ourselves a pre-VC stage investment firm. We're a bit unique in a handful of ways. We invest in companies when they're raising pretty small rounds, usually sub $500,000 rounds. So they're generally smaller than even pre-seed venture capital rounds. And the other unique thing about us is we use quantitative data-driven investment process. So we gather up a bunch of data points about a company, and then we're pretty much giving a pretty firm yes or no answer in about a week. And then each of our funds, a typical venture capital firm might have 15 or 20 companies. And each of its funds, maybe 30 if they're real active. And each of our funds has many hundreds of companies, like it could be 500 or 600 portfolio companies in each fund. And, I'm basically a career entrepreneur, and I view Rightside Capital as sort of my third startup. So we're not really operationally structured like most venture capital firms. We're structured more like an operating business. We sort of think of ourselves as a tech startup whose business model happens to be funding other tech startups. And you asked about my career and journey. I've pretty much been an entrepreneur since I graduated from college in 1992. I started and ran a computer hardware company in the 1990s, software company in the 2000s, was an angel investor on and off from the mid 90s to the mid 2000s, and then started Rightside Capital in the late 2000s, and we began investing in 2012.
Very, very clear summary. And there's really so much to jump into because I think there's a lot of unique things that you do at Rightside Capital. But, before even jumping to that, I would love to just talk about you founding two technology-based companies in the Bay Area over 2 decades. As someone who has been there and done that, and is actually still very much involved in the space, in your eyes, how has the landscape for startups changed over the years?
Oh, well, it's just changed incredibly from when I started. So I graduated actually Stanford in 1992, and I only knew one other person at the entire school that was actually doing a business when they graduated. And when people asked me what I was doing, after I graduated and I told them I was starting a company, they'd look at me with a blank stare, like, what do you mean? There were literally zero resources available. I think I remember, we needed to figure out how to incorporate ourselves. So I remember driving over the Bay Bridge to Nolo Press, I think it was called, in Emeryville, and buying a book from them about how to incorporate. And there are just so little resources. And if you just, fast forward, a handful of years later to the late 1990s, if I had graduated then, there would have been a fair amount of resources probably available on campus. And, there were a lot more structure even to the entrepreneurial world in the Bay Area.
That's really right. It's so much more easily accessible, I guess, right now to become an entrepreneur, and also, I guess, less risky in a lot of ways. So you jumped into entrepreneurship right after graduating Stanford. Is that what you had always planned to do? And can you tell me what was going on at the time to make that you made this decision? Like you said, you were the only other one, except for one other person who even.
Yeah. I had no plans my senior year as to what I was going to do. I didn't interview with any company. I knew I was just not going to go join a large business. I'd always been entrepreneurial. I did a lawn mowing business with a friend in high school, sold Cutco doors, knives door to door in high school. My only normal job for a year in college, I was a bank teller at Wells Fargo. I did ran a student painting business in college. And then I didn't really have, most of that was just to make dollars to sustain myself. And then I fell backwards into $10,000 2 to 3 months before I was going to graduate college. And it's a funny story, actually. I guess my parents had second mortgage their house, put me through school, and they were looking around and in a drawer found an envelope that had some stock certificates, some bonds, some things that I had been given like when I was born, maybe by some relatives. And they had already paid my last quarter of tuition. And they sent it to me and they said in the mail with a note that says, I think all of this is worth about, $1,000, but we don't even know how to turn it into cash. If you can figure it out, you can have it. So I opened this manila envelope up, went and bought a newspaper and started looking at the stock symbols. And the first thing I opened up was an IBM stock certificate, and that was worth $10,000. And then the rest of it combined was worth $1,000. So it was actually $11,000. And another job I had in college was a sales rep and at a local computer company that built servers, workstations, stuff like that. And I had also learned how to build the computers. And the person that ran it, I'd always told my girlfriend, he just did everything I can imagine wrong with this business and somehow stayed in business. I was like, it's got to be a way to do it right and do well. And so she had said to me, well, I have $10,000. What if we took your 10,000 and my 10,000 and you started a computer company and you did everything right? And I was like, okay. So I didn't have a spreadsheet at that time. So I just got out some paper and did some modeling. And I said, all right, well, I think if we do everything right, if we're profitable after 3 months, we could stay in business. So I called up my parents and I told them, hey, guess what? You sent me 11,000 instead of 1,000. How about instead of sending it back, I do this? And they said, okay. And so we went into business, miraculously turned a profit in after month 3. And I ran that for 13 years. It's a crazy start. I always remember that because, when I talk to entrepreneurs and work with entrepreneurs all the time now, and I just have to remember that like my job, even though I'm crazy experienced, both on the, the entrepreneur and investor side, I have to watch myself anytime I'm saying something like that's insane or that's crazy or you definitely shouldn't do that. It's like if someone came to me right now and said, hey, I'm going to open a computer hardware company with a retail store location and we're going to spend all our money and we have to turn a profit in month, after the 3rd month or we're out of business, I would try and talk them out of it and tell them they're insane. And yet no one was around to talk me out of it and it worked. So part of being an entrepreneur is sometimes doing stupid, irrational things that everyone else thinks is insane or crazy, and you just think seems perfectly acceptable.
That is such a beautiful story. And it's almost like the way I see it as well, it's very serendipitous. Like the universe was your first initial investor giving you that $11,000 and
completely. Yeah.
Has that, I guess, influenced you in any way? Because, let's fast forward a little bit. Did you always also want to become an investor into early stage startups? And, why are you doing this?
No, I never had any goal to be an investor. That first company largely bootstrapped up to being profitable. I didn't raise venture capital or really raise outside capital. I got a loan once from somebody and repaid it. So when I graduated from school, I didn't even know what a venture capital firm was or what angel investors were. And I didn't need them because I'd gotten this business profitable and then it was profitable and I had just more spare cash and the late 90s, the internet sprung alive and the World Wide Web. And we started to have all these companies take off. And I was selling a lot of high-end workstations and servers to a lot of the first generation of .com companies. So I was very familiar, I was a little more familiar with technology startup world and just naturally started coming across some investment opportunities. Did some investments. I wasn't super active. I mean, maybe like 8 investments over 10 years or something like that. And then started another business that was a little more capital intensive. And we ended up raising from an angel investor, angel group, and some venture capital firms. And I was fortunate when we were raising from venture. I had another entrepreneur who had raised from venture capital before that helped sort of mentor me through the process. I really had no idea how it worked. There were no resources. And this was like 2003, 4, 5. You know, even though the internet existed, there were web pages to go to. There were no websites that told you how the venture capital market worked. You couldn't even go out and find lists. You know, these days, everything's so transparent and there's all this data parity. Anyone can go out and find a list of every VC firm on the planet. You couldn't do that back then. So, you know, you had to figure out how to get warm intros, network through everything. Very, very difficult. And even after we got investors and closed them, I had even no idea what venture capital firms did. I just assumed they're investing their own money. I didn't even know they were investing investors' money. You know, it didn't matter. I was just an entrepreneur building companies. That's all I cared about.
You know, I'd love to dig into that educational process there, because you put yourself in situations where you almost had your back to the wall and you had to just learn, you know, like sink or swim. You know, so what was it like when there's not many resources around? How did you go about learning? Was it a steep learning curve for you at any point?
Yeah, I mean, I think the hardest part at first, like in the early 90s, you know, I'm this 22, 23-year-old kid running this business. You know, we were selling mostly to the corporate world, so I'm dealing with corporate buyers. I've got employees. You know, you don't learn in school how to do any of that. There's no part of going to school teaches you how to hire, how to fire, how to manage people, get the most out of them, what it means to be a good boss. So a lot of that, you know, I just learned by doing it. Trial and error, making mistakes, you know, being good at some things, bad at others, you know, learning along the way, tweaking and changing what I did. Yeah, so much fewer resources, so much easier now. But even in today's world, like first-time entrepreneurs, when they're building companies, they didn't learn in school anything about how to run a good hiring process. What makes a good boss? And most people's intuitions, I find, is completely wrong. Like my biggest learning, I think, on the operator side is I think everyone's intuition when they start and you're a boss for the first time is you want your employees to like you.
Yes.
And that's actually the complete wrong type of boss. It doesn't mean you have to be a mean or nasty boss, but ultimately employees don't want a boss that they necessarily are going to go have a beer with or go have fun with or do this. It's sometimes a benefit if that is there. But what I learned is that employees really want is they want to have enough information and guidance that they can know and understand whether or not they're doing a good job. And what really makes people satisfied at their jobs is feeling successful. And you have to create a culture and a framework where people know and can judge for themselves whether they're being successful. If people are working and doing stuff and they don't know if they're, you know, how to judge if they're successful, that's difficult. And job satisfaction comes from feeling successful and like you're, you know, maturing and getting good and gaining skills. And people can like you or not, but they'll respect you and they'll stay with you forever if they feel that. That was my biggest learning. But hey, I didn't know that when I first started.
Yeah, you're right. You're right. And I think that hiring thing, even for myself as an agency, once you realize that hiring and onboarding and actually getting someone, you know, onboarded, right, that is one of the hardest things to solve initially as well. And it's one of the big, I guess, lever movers in getting you to pass a certain revenue point. So yeah, thank you so much for sharing that. I'd love to jump, of course, into right side capital as well a little bit. You know, I've heard it described as one of the most active pre-VC stage investment firms, as you said, in the US. And with investments in over 1,400 portfolio companies since 2012, I think that's probably pretty accurate.
Yeah, it's closer to 2,000 now, but that's okay. It's a large number regardless. Yeah.
1,000, that's amazing. Yeah, in your first year alone, from what I can tell, the team made 79 investments. What was that first year like? Did you have any worries or concerns in that first year?
Yeah. Well, I mean, everything about our investment model was sort of theory at first. Like, we built this fast, transparent funding process because that's what we needed to do to build up these large portfolios. Our biggest concern was there'd be this negative selection bias. What if it turns out only, the worst companies or the worst founders are attracted to that investment model? And there's no way to know until you start going out and you're doing it. But we discovered, and sometimes it's good to be both good and lucky, is that this product that we built sort of for our own selfish needs turned out to be the exact product that entrepreneurs covet. There are not other investors out there, or very, very few, who very transparently describe exactly what they're looking for as far as investment profile, what their exact process is, and then have this very fast, transparent funding process. It certainly didn't exist in the early 2010s that we were aware of. And so it turned out that this product we built completely for our own needs was the exact product that the market sort of craved. And we ended up having this great product market fit. So we didn't even, it's not, we were just hoping to have no selection bias that was or negative. I think we ended up with a very positive one, because it turns out our overall value proposition is understood the best by experienced repeat founders, because they've been through the fundraising grind. They're aware that we're saving them 4 to 6 months of fundraising.
Yep.
Younger founders who've never done it before have no appreciation of what that savings is all about.
Yeah.
So it's interesting.
You've mentioned that product a lot, and of course, like you said, your decision-making criteria is very unique in the sense it's also very transparent on your website, which is very refreshing. I'm sure many people find. But what I'm curious about is what happens behind those closed doors, because before being taken down in 2013, Kevin, your partner, mentioned that the team uses an algorithm as a spreadsheet to make decisions. I think which he coined it Moneyball for tech startups. Is this still being used today in any new form? And I guess
it is. It's not that we plug a bunch of numbers into this black box and it spits out a yes or a no or stuff like that, but it's very algorithmic. The biggest difference between how we operate and how I operated as an angel investor, or how any early stage investor or investment firm operates, is me as an angel investor, and pretty much any venture capital firm right now, when they're doing diligence on a company, they're actually trying to determine if this specific company will succeed or fail. Like, that's what they're trying to do. And just, our philosophy is that's sort of impossible at this early stage at which we're investing. It's the variance of outcomes is too strong. And if you wanted me to be really accurate, I would guess that every one of our companies is going to fail, because I'll be right a little over half the time, probably. So, the biggest difference is that we turn a given company into a profile. It's got some amount of revenue, traction. It's got some growth rate. It's got some amount of capital it took to get there. It's got some cash burn. It's their, unit economics type of business model, some stuff about the founding teams. And then we're asking ourselves, hey, if we invested in a pool of 50 or 100 companies of this exact same profile, with the round terms of this dynamic, how would that pool perform? And we're able to do that because whatever that profile is, we probably will invest in 50 that are like that. And so we don't feel like we can say within that group of 50 which ones of those will be successful or not, but we are very good at identifying profiles that perform well. And so, that's how we work, and that's what we do. And we're able to articulate that very well when we're talking to founders and they understand it. It's interesting. We get some of our best compliments, and also get a lot of referrals to companies from founders that we've said a quick no to, because they've just had a great experience getting a fast no, and they understood exactly why we were saying no.
Yeah, when I speak to a lot of founders, they say that not having to chase up an investor and being able to cross someone off. At a certain point, they typically say, like, after the first no's, every no after that is good, because they don't have to waste time, so they can just take people off. So I'm sure.
Yeah, exactly. A fast no is very valuable. I found that when I was fundraising.
Exactly. So when you do invest in a business, what happens after? Because I'm curious, how closely do you work to support these 2,000 very different companies, or do you prefer to be hands off?
No, that's changed over time. Obviously, when we started, there were just 3 of us. Now we're a team of 12. So we have a lot of post-investment resources available. So I'd say that the biggest things are we've got sales, marketing, fundraising resources. And we put on a bunch of webinars, monthly webinars, some in-person events. So we've got a person on staff who's got our growth partner who's got 20 to 25 years experience being VP of sales, chief revenue officer at enterprise B2B SaaS companies. And he's available as a free resource for any of our portfolio companies to sort of strategize in anything go-to-market related, whether it's processes for hiring, for help with specific customer, comp plans, you name it. We've got the same thing on the marketing side. We also have built out a network of probably 1,000 to 1,200 pre-VC stage VC investors up to late stage private equity. So over the entire life cycle of your company, anytime you're looking to fundraise at sort of any type of round, we can connect you with tons of investors for whom you're a good fit. We do monthly sort of webinars where we bring in experts that talk on different topics that are relevant to founders. And then we have a handful of in-person sort of dinner events around the country that people come to. So that's sort of the value prop package after our check. And what we found is that, there's not a lot of investors or hardly any at our stage that we're investing where you get all those resources.
Definitely right there. Do you feel that since providing more support that your portfolio companies are doing better off in any way?
Yeah, I would say it's probably too early to judge from pure numbers because that team started to get built out maybe like 4 to 6 years ago as we were adding people on. But the feedback that we get from founders and some of the impacts we see on the companies is just enormous. It's too early to tell. Does that translate to a lot more huge winners or not? Don't know. We believe it will.
I guess we'll see. Maybe I'll interview you again in 4 to 6 years.
Yeah, exactly.
Yeah. I hope my numbers are right, but I counted 195 successful exits for yourself. So, firstly, congratulations. When this happens, how do you celebrate? Do you go back and analyze at all? What happens on the back end?
No, and I would say the thing to understand is like we might have 195 exits, but it's a tail-driven market. It's the very small percentage of big winners that still drive the largest returns. So 195 are probably exits where we got money back, right? And a large set of those where we lost a little money or we got back our investment or we got a little bit more. And then some smaller subset of that are going to be ones where we got some much larger chunk back. It's hard because the venture world, especially its early stage world, it's driven by sort of top 1% outcomes. Those are the 1 in 100 events. And even us, having made the amount of investments we've made and having so many companies go through full life cycle, that's not enough sort of rolls of the dice to really get a lot of insights as to what drives a huge home run. I would say, if anything, we have a lot of data and we've done a lot of analysis, and most of it points to the fact that it's much more of a random walk than people want to believe. Like the human brain is wired to always want to attach a story and a narrative to everything that happens. And that's just not how the real world works. Our companies that are wildly successful, some of them go up and to the right out of the gate. Some of them go sideways or up and down for 3 months or 3 years before they start taking off. And, I know that from, we've had companies that have just all of a sudden gone off like rocket ships over a 12 or 18 month period. And I talked to the CEO 2 months beforehand, and they had no clue anything like that was about to happen. It's very difficult.
Yeah, right. I think people don't attribute luck as much as they should on certain things, but also I guess maybe that's human nature, and also it helps us get past, or at least be a little bit more optimistic on certain things.
Right. You just want to feel like you have a little more control over, over what's going to happen. But I think there's a lot more randomness in startup success than people want to believe. I mean, you have to be good as well, but you have to be good and lucky, and sometimes have the randomness go your way.
Let's talk a little bit about that skill and what being good looks like, because perhaps I'm not looking in the right places, but something I don't hear much about is how and why someone becomes an investor and how they get good at it. Over the years, as one yourself, is there anything you've learned that you think helps you pick winners?
Yeah, that's a good point. There's not a lot of reading up. I find that most people, if they start, it's a very common path. As an entrepreneur, you get successful, you've got a little more money, you have an exit, you start doing some angel investing. And for the most part, we have a lot of founders, even of our own, that start doing that afterwards. And I think most people in the first couple of years when they start have no clue what they're doing, and it's hard to know what a good deal is or what isn't. I think, we probably didn't have as much of a great idea either at first if you had asked us, any of us individually, on some subjective analysis, to do some. But fortunately, we had sort of a quantitative model that we used, and we were able to apply that. And we were trying to sort of, at first, just index and reproduce what other professional investors were doing in the market. I think over time, we got much better than that, or we have gotten. But yeah, a lot of our expertise comes from just having so much data and insight and having done it so much. And it's hard to get from zero to there without having done it, having made mistakes, and having learned a lot. I don't have any magic bullets of advice on the investor side. My one thing I would say for tech investing is you cannot make a living where you're just going to do a small number of investments and just pick the winners. That's too hard. I've never met almost every very successful, very early stage investor I've met, whether it's a fund or an individual angel, has done a very high volume of investments. And usually the biggest winners are from their smallest checks where they had the least amount of confidence is interestingly the common theme.
It really says a lot about the entire space. And you came into this with a theory that, hey, if we invest in a larger number, law of averages is gonna work things out, and we're gonna get a specific return back. Now that you've done 2,000 investments, like you said, has that theory been proven in any way for you guys?
Yeah, it's worked out. We've been very successful. I'd say it's actually worked out better than we had anticipated. Even part of it is just us being in the right place at the right time when the market moved our direction. Unfortunately, sort of SEC regulations don't allow me to talk about anything about our returns in a public forum or do anything like that. But what I can tell you is some of the dynamics of the marketplace that have just worked in our favor. So I think what we're doing works very well, but it also happens to be the case that, in 2010, the price to build an initial version of a software product had dropped to probably $1 million. And we thought that was so crazy cheap because, it was probably 4 or 5 million 10 years earlier, and it was 40 million 20 years before then. And all of a sudden, I'd say between 2010 and 2016, the cost to build a first version of a software product dropped to, 100,000 on average, or zero if it was just a bunch of technical founders. And so that just caused an explosion of startup activity. And that sort of, went from most of the startup ecosystem being in a few main coastal cities to all this innovation happening everywhere, all across the country, in every city, and lots of startup accelerators happening. And so there was this explosion of new startup creation, and there were way more people who needed smaller checks. And the investor world just didn't have any real good answer or solution to that. So I think we were in the right place at the right time when supply and demand went wildly in our favor, and the cream of the crop went from being all pre-revenue to suddenly having some decent traction. So that's just, that was just us being as much, I think, a combination of good and lucky. Like I said before, that was our business model, being in the right place at the right time. I think a lot of startup success too is you having a business model that ends up working, and you're in the right place at the right time for that business model to work.
Amazing. I love that you bring that up about, I guess, having an explosion of startups who are just looking for you. You almost had that product market fit, and people are almost pulling you towards them. I noticed Scott Shane is on your team as a deal flow partner. So besides inbounds from the submit form, are there other methods that you guys do to look for the right startups that you guys are interested in?
Yeah. So when we first started out, it was a challenge. Like, how are we going to get all these companies to look at, to invest in? In today's world, they come from all over the place. I don't think we have a specific, dominant channel. So where, the startup accelerator world's a great source for us. We are going and looking at companies because we make such quick decisions. A lot of managing directors bring us in to look at companies like early on in the program instead of waiting for demo day. We've got, 2 to 3,000 or maybe 2 to 4,000 active founders who are sort of scouts on the ground that send us stuff. We've got a very large brand, so we get just tons of inbound on a daily basis. And almost wherever you are, you could be in Texas and look up the 10 most active investors in Texas, the early stage, and we're going to be on that list probably, even though we don't focus on Texas, because we do a lot of investments everywhere. And then that whole huge list of 1,000 plus later stage funders that we refer companies to, they send stuff that's too early that they come across to us. And then you add in personal networks, our investors. So it's just a little bit of everything. I mean, one of the cool things that we really love is it just makes no difference. Like a really good friend of mine could refer a company to us, or someone could come and fill out the form on our website, having never talked to any of us, and they both have the exact same chance of getting funded, because we don't care where the source it was, if we knew you before or not. It's all about the numbers for us. So there's a lot of great offshoots from that, interestingly.
Yeah. I think hearing that, if I was a founder, I guess listening in on this as well, I'd feel a lot more hopeful, because of course it's very hard to have those investor connections, especially early on in your career. So knowing that if I submit a form, I probably have the same chances as someone being warm referred. That's of course, I think it's a really good message. If a founder from a startup were to contact you directly without an introduction, is there anything they could do to capture your attention? So I'm saying they didn't actually fill out the form at all. They just emailed you directly. Does that work at all? Is there anything they can do to capture your attention?
So when someone emails me, I'd say 9 times out of 10, I'm emailing them back just from their description in their email, or if they put a deck, me reading it for 15 seconds, I can tell they're not a fit for one of 4 or 5 reasons, and I'll email them back a quick description of what we do and why they're not a fit. I'd say, occasionally I'll get an email from someone who's actually read our website, and the email will say, hey, I went to your website and we seem to fit exactly what you're looking for. And they give us the key metrics that we're looking for. And, if that happens and they've sort of pre-screened themselves, that's much more likely I'm going to have a positive reaction. But my reaction is still, that's great. As a first step, go to this pre-screening form at our website and fill it out. And maybe I'll just say, put that you spoke with me when you filled it out. So that data will go into our database and then get sent to me as opposed to someone else. But it's all of the deals we evaluate flow through our website, whether it's someone randomly filling that out or me driving someone there.
Amazing. One very topical thing that we always discuss internally as well is pitch deck or not in that first email. What's your preference there?
Makes no difference. Pitch deck's probably better because I can, for us, because if it's got actual metrics, if the pitch deck just says, here's what our product is and what we do, then it doesn't give me any information. If it talks about your traction, your growth, how much you've raised, or what type of round you're looking to raise, it gives me some insight. But it doesn't matter. I mean, if you email out of the blue and it doesn't say much of anything, I'm just going to respond back with an email that gives a few sentence overview of what we do. And I'm going to send you to our website and say, hey, go read our submit page. You tell me if you think you're a good fit. If you think you are, fill out our form.
Yeah. I noticed on the website, there isn't a lot of detail about what you look for in a founding team on your website. Is that intentional? Because I understand it can be quite abstract to measure founder characteristics. Was that something?
Yeah, that's changed over time. I think when we first started investing, almost everything we invested in was pre-revenue, because in 2012 and 13, companies raising sub $500,000 rounds were usually still building a product, right? Maybe they had a free beta user or something like that. So at that point in time, we cared very heavily about a founding team's previous startup experience. Had they taken an idea from paper, build it out into reality, started generating some revenue or raised some capital behind it. And the biggest thing that we were looking to avoid, we didn't want a company to operationally implode before the product even got to market, right? If we invested in a company and they brought a product to market and the market rejected it, that was fine. And we were okay losing money there. We didn't want to lose money because the team just operationally blew up or couldn't build the product and get it to market. So we had a much more heavy emphasis on repeat entrepreneurs, people who had managed people and budgets and taken ideas from from paper to reality. Today's world, that's not as important because everything we invest in already has revenue for the most part. So any company that's going to blow up and die before their product is even built and gets to market and starts generating revenue, that blow up happens before you even get to the front end of our funnel. So anyone we're engaging with has a live product, has revenue. You might be an inexperienced team who hasn't done it before, but you've already separated yourself from the pack because you've gotten our live product and you're generating revenue. So in today's world, it's a little bit different, where I'd say for founding team evaluation, we're really trying to gauge whether you're an average, above average, or below average team. And the things that we look for, like what would make an above average team, what are the characteristics that are key? Previous startup experience. Like, is there someone there who's been the CEO of a startup or co-founder, has experience raising money, knows the startup world dynamics? Is there a technical founder or two? Like, it's much harder and a higher bar for us to invest in non-technical founders. Is there domain expertise within the founding team in the area in which you're building your product? Have you managed people and budgets before? Things like that. We generally very, very rarely get a team that checks all those boxes. But everything I mentioned is stuff that you can really easily tell from both the LinkedIn profile usually, or just a few minutes of talking with somebody. And I would say, it sometimes it knocks the company from a yes to a no if it's a really lower quality team. A lot of times it just means we have to change the price a little bit. It's a much riskier operational, it's higher operational risk. And maybe instead of doing an investment at 4 million, we're doing it at 3 for that same profile. So we get paid for that extra risk. Yeah, what we found is that when we're transparent and we tell companies exactly why we're pricing it here and exactly what our thoughts and concerns are, they're super appreciative and understand.
Amazing. And that makes a lot of sense. Of course, you want to measure this, and you want to see, is there a technical co-founder and domain expertise, something that we typically hear a lot of the time as well. I know we're kind of running close on time here, so I would like to wrap things up with a very simple question. What's one thing you love and hate, or maybe dislike about being an investor and what you do right now?
Well, on the love part, I'm just sort of an entrepreneur at heart. It's all I've done my whole life, really, aside from, I guess, hopefully being an entrepreneur on the investor side of the fence right now. So I just love getting to work with entrepreneurs, day in and day out at all different stages of companies. I could have 4 calls in a row one morning or Zooms, and 2 of them could be companies, struggling to get to 1 million ARR. And then the next 2 calls could be with a company with 3 million and then 30 million. It's just a wide variety, and that's exciting. And seeing those founders be successful is just so rewarding. I think on the things that I don't like, the reality is when you're an early stage investor, like most of your investments don't work out and they fail. And sometimes they fail in spectacular fashion. And sometimes entrepreneurs that you get very close to and that you're really rooting for hard, their businesses don't work out or blow up. And there can be a lot of pain around that. I also think that, as with any business, like a lot of the business part of running a venture capital firm isn't fun, whether that's legal, finance, regulatory compliance, audits, all the stuff that you just have to do as a business. At least that's stuff that all falls under my purview here, at the very high level. And for me, that's less fun than all the interaction with the portfolio companies.
Amazing. Thank you so much, David. I absolutely have really enjoyed this chat. I think you've created a lot more transparency around this space as well. Really love what you do. And I think, in a large way, you're actually changing the world as well with the startups that you support as well. So really appreciate the time that you've put in.
Awesome. Thank you. Very happy to be here.